Hi everyone, and welcome to this month's edition of On Track. Rob McGregor here, and it's the 28th of February as I record this, and the year's off to a flying start. And today we've got all the latest news up to the minute, performance figures to the end of January. As usual, just a quick warning, this advice is prepared for clients of McGregor Wealth Management, and particularly those that use our care investment philosophy and process. All else welcome to listen, but please get advice that's specific to your own circumstances before acting on anything we talk about. Today, we're going to cover off on all the latest economic news, and there's lots going on. We're going to look at the returns and have a look at what's happening around property interest rates, share markets, and as I'll put in perspective around our philosophy of exciting life and boring money and not the other way around. So lots of news happening. So inflation continues to ease around the world, or we've got some slight uptick in the US. Interestingly, you can see the numbers on the right. We had a first RBA rate cut, so down to 4.1%, the cash rate. The first of what might be a few, although consensus is varied. The predictions from the big banks economists range from 2 to 5 rate cuts. How's that for economists not agreeing on what happens next? So that, to put that in perspective, for with mortgages, we've had average rates of about 6.12%. If we get 2 rate cuts, that'll put it down to about 5.6. If we had 4 or 5, that'll get it down to about 5%. Massive difference. I know anyone with a mortgage will be cheering on the latter, but be careful what you wish for, because if it's going down that much, it means the economic news probably isn't that great. Yeah, and they're trying to stimulate the economy. If the economy goes well, it's probably only likely to be, around about 2, but time will tell, and there's a lot going on. 90-day bank bills down a bit. We're going to see that. We see right down the bottom there, term deposit rates will start to fall, and I suspect a year out from now, term deposit rates may have a 3 in them after a good 18 months of nice high rates. So if you've got long-term term deposits, you might want to think about the strategy going forward as rates drop. 10-year bond yields haven't changed too much, fairly stable. We'll talk about that some more shortly. The Aussie dollar's tapped below 61 cents occasionally. It's at 63 cents as we speak today. Aussie CPI is steadied in about that 2.5%. You'll hear the media talk about all sorts of other variables, trimmed mean, all this other stuff. None of it matters too much, except we're close enough to the zone, and then it's just what the future forecasts are, particularly from the Reserve Bank. US inflation, yeah, about 3%. It ticked up and got down as low as 2.7. There's lots of different measures, so the devil's in all the sub indexes here. Mortgage rates, yeah, we've got a 5 in it now, which is nice for those with mortgages. Although the banks haven't all flown through yet. Keep an eye on your bank, make sure they're passing on the mortgage rates. As we look across to the US, yeah, and Trump inaugurated in January. Since inauguration, 73 executive orders signed. It's a record by any president ever. So that's where the president gets some power. It's different to where they've got to put things through Congress. Some of that power is quite limited, but it's certainly action stations. And depending on which media you watch and who you listen to, you'll see everyone from they think he's the next great thing that's going to change the US economy to those that think he's going to ruin it completely. Never before has there been a leader so divisive in his own country. I don't think, but there's probably been a few if we think about it. Either way, the markets haven't reacted too much. That's a good sign. Part of my morning ritual, I roll out of bed, have a look at what's happened in the US markets and see whether there's been any crazy announcements. So we're all a little bit obsessed by what's happening in the Trump world at the moment. It's certainly interesting times. Back to Australia, we've got an election that has to be on the 17th of May or earlier. Anthony Albanese will likely call an election in the next few weeks. He can have it before that, or he can have it on that. That will coincide with when the budget would normally be due. So if they go earlier, they won't announce a budget. They may do an economic statement just to bring it up to date, but they may not do a budget, or they may do an early budget. We're watching that. ASX 200 hit an all-time high in February. It's backed off a little bit, but not too much. Unemployment remains incredibly low in the States and in Australia at almost record lows. So that's a good thing. And the global economic outlook's a bit uncertain at the moment, particularly around trade. particularly around tariffs, as there's a bit of uncertainty around what might happen. And we'll talk about it a bit more, but shares are a little bit in the expensive zone. This chart from Shane Oliver at AMP shows the equity risk premium over bonds. So when it's down the bottom, shares are getting a bit more expensive. In other words, both shares earnings yield is quite similar to a 10-year bond earnings yield at the moment. So you're not getting a risk premium. Normally, you would expect to get a risk premium for investing in shares. And that means one of two things. It means the market thinks that there's going to be so much growth in the share market that it doesn't need a risk premium, or that the market's overvalued. And the truth is probably somewhere in between, and we never know the answers to this till it plays out. We think the market's a little bit expensive, but nothing to be concerned about. When we look at returns, and when we're looking back a year from the end of January, the funds have done incredibly well. High growth, nearly 18%, growth 16. When you look over 3 years, they're just over what we'd expect long term, and at 10 years, almost bang on what you would expect long term. So ideal. It hasn't been a crazy decade. It's been a decade that's consistent with those long-term expectations. And shares, Australian shares only produced 8.5% over the last decade. International shares 13, but the Aussie dollar dropped for a bit of that. So if you take out the Aussie dollar impact, international shares about 10. So they're not crazy numbers. And the time that people might get a little bit worried in the share market is when we've had crazy booms, and we just have not had crazy booms. And as I've talked about in latest episodes, the only thing that's booming well is the technology space, and that's potentially mostly justified. It's a complex subject. So here's the last 20 years and our wall of worry, and we'll see we're bounding on. You'll see us those new highs we talked about right at the right hand. And so we're in new territory, but the market spends most of its time in new territory because it does go up. Gravity in the markets is up. That's normal. We still think we're firmly in the wall of worry, but we do also think one of these corrections of that 10 to 20% is probably probable this year. Doesn't mean we don't finish the year higher, but it means with all the volatility in the world, we will not be surprised if there's a drop of somewhere between 5 and 20%. We would expect that to be met with buying and a recovery, depending on what the news actually is, but anything's possible. So just on the exciting life, boring money update, as we look at the trouble that's out there potentially for people, this is one that concerns me. Industry super funds have been a marvelous thing for many Australians. They got the cost down on superannuation investing. They provide a really good option compared to the old banks and insurance companies, which didn't do such a good job and ended in Royal Commission. But there's an increasing likelihood that we may end up with some sort of inquiry at the moment into industry super funds. They've got a lot going on. Some of the highlights out of this article from the Australian, payments from industry super funds to the unions. So typically an industry super fund has union members on their boards. Those payments to those members are then transferred to the Labor Party, and that's part of the funding of the Labor Party. So make no mistake, the Labor Party is funded by industry super funds. The opposition, and when they're in government, had tried endlessly to force industry super funds to have independent directors, just like you have for companies and most other investment bodies. But they've resisted. They don't want to have independence because that would take away the money that goes to the Labor Party. So that's coming to the fore. We saw this with the CFMEU. So where's that in the article? So CBuzz is a building industry super fund. It's had pretty good returns for members over the years, but it's in a bit of a quandary at the moment. And there's 912 partnership payments made from CBuzz to the CFMEU. And a lot of that then is transferred onto the Labor Party. So this is a hot topic. And then you've got issues around exposure to unlisted assets. So industry super funds have a large exposure to unlisted assets. And that's been a key of their success. But there's a disparity in how those investments are valued, which makes it hard to be giving daily prices as people come in and out of the fund on a daily basis. And I've got Yeah, I've got concerns about what people are paying to go into industry super funds at the moment because they haven't marked to market a lot of their unlisted assets, amongst other things. So watch that space. If you've got industry super funds and you'd like to talk to us about those, we're more than happy to talk to them about. They're not going to blow up and go to zero, but there's some trouble ahead, and that may mean lesser returns. For instance, in that last year when our balance fund was earning about 16%. Some of the leading industry super funds were closer to 11 and 12. Now, while that's okay, 5% difference was really them not being able to upwardly value those unlisted assets that they haven't valued well for the last 3 years in particular. So it's a complex story. If you've got it or you know friends that have got industry super funds, very happy to talk to them about what it is. But there's more and more articles coming out in the press, and I think if the coalition is successful, they may end up with the Royal Commission into some of the industry super fund behaviour. And that may be their moment where they're vulnerable to outflows, fines and penalties. And because they don't have capital, that may affect their members' performance as well. Yield curves, you can see the dark line. Top left is the US yield curve. So 10-year bonds haven't moved much over the last month. A little bit of action at the short end as rates drop. Australian yield curve up a little. So 10-year bond rate still around that 4.3. You can see the blue line here shows it oscillated over the last 12 months up to nearly 4.7%, down as low as 3.8, settling around that 4.3. Yeah, if there's some confidence in the economy over the next year, we might see these long-term rates drop, and that would definitely cement mortgage rates drop. If there's continued volatility, you might see these stay around about this level and even pop back up to the top of that range from time to time, which will keep pressure on mortgage rates not dropping. As always, our context for looking at the market is around what we call the wall of worry. And markets go through the boom, the bust, and the wall of worry. We're quite firmly in the wall of worry at the moment, albeit on a little bit of the expensive side, but not. We don't believe we're in a boom that has a likelihood of a loss like these of more than 25%. So once again, this is the 9 biggest losses since 1900 in Australia. All of them bar COVID, caused by booms that resulted in busts. But as all of these show, they all recover and go up. And we design our whole investment methodology around the inevitability of these things happening. So we're always on the watch for where we are with fear to FOMO. So we have that dial at a 10 at the moment. So it's a little bit expensive, not crazy, but still firmly in the wall of worry. I've highlighted in our mess it up. So just a reminder, the mess it up is just a series of letters that remind us how easy it is to mess up investing and all the influences that cause us to mess it up. On the right hand side here, we've got the cost of that mess it up, which is the difference between the returns that investors get and the returns their investments get. So that's on the right hand side. Yeah, and the example here from Delbar, who's been running studies on this for well over 30 years, the S&P 500 over the 30 years up to the end of this study, which was the end of 23, 10.15%. Investors in equity funds only a return of 8%, and that's because they buy and they sell, they get out and they get in, they zig and they zag, and usually at the wrong time. And you can see the costs for that average investor over a lifetime, about 800,000, and that's just for 30 years. I would argue the cost for most people is closer to 2 million over a lifetime of getting that wrong. And these are the reasons they get it wrong. And I've highlighted today short-term focus and single issue focus, because the short term is all about what's Trump said overnight. Single issue, Trump, 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 Trump. We'll all be sick of him completely, one way or the other. We'll see how it all works out. Maximum, there's 4 more years. And he will do some things which are really good for the market and some things the market might not like. I'll leave everyone to make their own political judgments about that, and I'll stay out of that. It's such a hot issue. But yeah, so far so good market-wise. Lots of things that people might think are not so good otherwise. That's led me to reinforce the behavioral bias that I think is in focus at the moment, which is recency bias, which is where we where we overweight new information. So we're looking at what happened last night. What did Trump say last night? Now, the bigger picture of share markets over hundreds of years, this will be a nothing, literally a nothing, just a continuation of the upward line with a bit of volatility. So there's a real danger of becoming obsessed with recent information, which is why I talk about this stuff, because my main goal of talking about all this is to make sure our clients stay calm and not worry about the inevitable turbulence that you get from all this stuff. And as always, our clients have been great through everything here. Now, the two things I've highlighted here in our investment process methodology basis is rebalancing and volatility, and they're joined at the hip. So if you have volatility, and if volatility is inevitable, which we do, then rebalancing regularly. So within our portfolios, we look and consider rebalancing every month. We don't always rebalance, but if there's a disparity, we rebalance. What does that mean? Rebalancing means we get the portfolio back to its benchmarks. Let me give you a really simple example, and I'll talk about during COVID. So if you had a portfolio that was 50% shares and 50% cash during COVID, which we would never recommend, but it's for the simplicity of this example, and when the market dropped 36% during COVID, you would have immediately taken some of your cash and bought shares to bring it back to 50%. So you would have been buying when it was low, and then when the market recovered, you would have sold some shares, got some more cash to bring it back to 50%. So even though the market went sideways for this 6-month period, you would have made money just from rebalancing. So the more volatile, the more money you make from rebalancing. So it's a friend, and it's certainly a contributor to the care investment process performing well above average. So we look at the individual markets, good month for Aussie shares. As we said, we hit new records. You can see on the chart on the right, we've backed off from that. So it's come back, which is healthy. I'd be quite happy for the markets to go sideways for the next 3 to 6 months as they allow the profits to catch up. Any crazy boom always creates the risk of downturn. 1 year, 15% on the Aussie share market. And you can see the variety of returns when you look down from Commonwealth Bank at 38%. It's been an amazing year. To CSL, once the great growth stock of Australia, down 6% over the last year. Still been spectacular for investors. So you can see the variety of returns. Aristocrat Leisure, poker machine manufacturer. It's a bit sad that they're the highest performer at 64%. But hey, that's investing, and a diversified approach got us a nice return of 15%. Average of nearly 9% over 8 years, over 10 years. And that has resulted in $10,000 growing to about nearly 24,000. So that's the power of long-term investing. US shares, 33% over the last 12 months, spectacular year. And as you look down through the companies that make up the ETFs, the indexes that we invest in, Apple a 33% year, NVIDIA, the chip maker, a 66% year. They did release their profits 2 nights ago, and they were okay. So there was a worry they might be starting to be impacted by orders not being as high if they don't need people don't need as powerful chips for AI. But NVIDIA is still rock solid. Broadcom, another chip company. So the chip company is really driving that, but the other tech companies also doing particularly well. Berkshire Hathaway, a nice 20%. And consistency there. $10,000 grown to 43,000 in US share investment for Aussie investors over the last 10 years. Same story exactly for global leaders, because most of these companies are US, and that's the same companies leading the charge there. Microsoft is the only one that had a negative year, but still a very stellar company that has literally billions and billions of cash backup, as does Apple. So $10,000 growing to about 42,000 there. US small caps. So that's you always, when you look at the names here, you'll never really know them, although some of them might be familiar to you. But you see the spread. There was a company called Hims and Hers Health Incorp. I don't know anything about those, but last year that got a 300% return, and guess what? You own it because you own index funds. At the same token, there's always some lesser stories. Although I'm not sure how you pronounce that, minus 34%. But the beauty of index investing is you pick up these emerging companies as they come through, and then get to ride that increase. So in the long run, that's resulted in higher returns for small caps, and that's why we have them both in the core and the active portfolios. In the last 10 years, a $10,000 investment in the index grown about 43,000. Yeah, quite awesome. Gold, it's actually the best performer for the last 12 months, 44% for return on gold. We've always got to remind ourselves that doesn't include any income. No dividends from gold, it's just capital appreciation. And the gold goes up when everything else is a little bit uncertain. And that's one of the reasons it goes up. One of the others is its value as a currency. So at the moment, the US dollar's strong. We're seeing that with low Aussie dollar, but no one really wants to hold any other currencies. And that's where gold picks in as a quasi currency. So that's been part of the drive. The high US dollar has dragged up gold price as well. And we get to benefit from that. Over the last 10 years, $10,000 in gold has grown to about 29,000. So it's a very important part of the portfolio, and we like it for its insurance-like nature, but also its protection against inflation and its value as a currency. So lots of reasons we like having that in the portfolio. Let's talk about property, and it goes through its different cycle. We call that boom, bust, boring. We've had a bit of a boom. The busts in property vary from just being stagnation to where it goes sideways to sometimes coming down. Value changes at the moment. This is the change in dwelling values around Australia. So we'll see the last 12 months. We'll look at annual here. The leaders, Perth at 17%, Adelaide 12%, Brisbane 10%, Melbourne went backwards 3.3%. And you'll see, and I've spoken about this the last few months, Melbourne is now the fourth highest median value of dwellings, or fifth highest. So it's actually now sitting behind Adelaide and Perth. And yeah, just ahead of Tassie, sits behind Canberra as well. So it's actually fifth, but this is a little misleading because this is dwellings. So this includes houses and units. And both Melbourne and Sydney have a much higher unit population than the rest of the country, both at about 38 to 39%. So about 38 to 39% of dwellings in Sydney and Melbourne are units compared to a range of 10 to 20 in most of the others. So if we look through that, and I will in a minute, that makes Melbourne much higher, but still the comparison to Sydney is as large as I've ever seen. So if Melbourne's economy stabilizes, and it's been a bit one down, it was the hardest economy hit from COVID lockdowns and the recovery from that, fairly high debt levels that leads to land tax and things like that affecting property markets. But Melbourne looks valuable at the moment, and we may see some increases. So this, I'll go through. There's a lot of information here, but on the left we've got a change in dwelling values over time, and since for the last 10 years. So you can see anything from Darwin, which has stagnated and actually lost money over the last 10 years, to Brisbane up 90%. And the right-hand column on that left-hand chart shows the jump since COVID. So Melbourne only up 7.8%, but you'll see Perth 76% increase since COVID, Adelaide 73%, 68%. And we had this big jump in regional New South Wales, regional Queensland, regional South Australia, regional everywhere really had also went up, except for regional Northern Territory, which is quite a unique market, of course. So yeah, interesting stuff. As always, you think about what affects property prices. Interest rates is one. So interest rates dropping should be a good thing for property prices. And I'll point out, as always, what's good for investors isn't always good for affordability for our kids and stuff. It's a moral dilemma, which I won't talk about, but it's what we try and do is just understand the nature. And if you look at population, so we look at where population is at the moment. So 27.2 million people comes from the ABS from somewhere, their estimation in the 2024 year, and by state. So see 31% of people live in New South Wales, 26% in Victoria, Queensland catching up at 21%. And you'll see the projected population growth, and it's reasonably even, or reasonably proportional, I should say. So in other words, they all tend to grow at a similar rate to what their proportion of Australia's population. So in the next, what do we got? 2025 to 2030, next 5 years, there's a forecast increased population of about 2.7 million. So that's That's going to exasperate any property shortages. That's going to be positive for investors in property, negative for people trying to find affordable property. So I don't see any let up of strong property prices, certainly no major correction, barring black swan events, and possibly some good gains for investors in areas. And we might start to see Melbourne catch up, I suspect, over the next 5 years. And it's an area we're starting to look at of interest. So other things that affect the housing market, first home buyers, so you can see this chart on the left. In the year to September 24, much more activity on first home buyer lending compared to the previous year, where it had actually gone down. So people got disillusioned, but then they went, you know what? Rents have gone up so much anyway. I may as well buy for those capable. So we've seen first home buyers driving the bottom end of the market everywhere around Australia. And then we look at the economics, which also affects property prices. And you'll see state by state jobs growth, and Perth leading the way there, followed by Queensland. No surprise, that's where property prices have increased the most. So there is this connection between long-term growth and property prices. And then you look at unemployment rate. So the opposite here, low unemployment is good for property, high unemployment is bad. And you see Australia, as you see Melbourne has the highest unemployment rate. That's contributed to it dragging. And if that improves, once again, we'll see Melbourne start to come back into the mix. Perth at 3 point, sorry, WA at 3.6, the lowest. So it's an interesting look at the dynamics, and it just confirms why the market's done what it does. Our stats here from Mosey don't really reflect the rate drop. We're seeing rates that 6.71 will be down around 6.5 now, but it just hasn't flown through yet. A lot of the banks set those rates to drop in March. You'll see it on their websites for new loans, but obviously anyone applying for a new loan right now won't get the loan for another few months. Anyone that's got an existing loan, they should get the benefit in the next few weeks. If you're not seeing it, make sure you check. If you're not getting it, hassle your bank or look to move. You'll generally get a reduction with the phone call. Property price, no change here. We're just waiting for a next update from our friends at Performance Property. But as I said, you've seen the bigger cities, particularly around New South Wales, Sydney, and Melbourne in Victoria, have been in that stagnation phase. And still got Perth in that buy value, Brisbane around the hold. It'll be interesting to see the next round of data, which we should have next month. But there's always somewhere to buy. And keep in mind, anywhere where you're buying the blue, the foundation assets here, will do extremely well in the long run. Australia's got a great property market. And if you think about that, that's our main growth capital cities. And they always have good prospects in the long run. But it is nice to buy an investment property and have it go up in the shorter run. So just to finish off in reinforcing our process, our core belief that all investing is best done as part of what we'd call a real plan, where we have goals that are specific to you, portfolio designed to meet those goals, and we take a long-term view where gravity is up in the share market, massive use of the boring stuff, diversification, the right asset allocation, and enough liquidity and low-cost access for most growth markets through index funds. And then our protection against the inevitable short-term volatility through reserves for our retirees and dollar cost averaging for our wealth builders, and the secret sauce, the boring stuff of rebalancing, which I talked about today. Congratulations on not doing any of these things to all our clients. Not that it's an issue at the moment because markets are up, but there is only 3 ways to lose money in the markets: panic and sell when the market's down, have to sell, and not properly diversified. Thank you. I appreciate your attention. I know some of you listen to this regularly, some of you less so regularly. We try and keep it up to date, but also brief and to the point. If ever you want to talk in more detail about any things we talk about, always happy to have a chat. If ever you'd like me to dive deep in a future topic, please feel free to let us know, and we can do some deeper dives on the occasional topic every now and then. So until next month, thanks for your attention, and we'll talk soon.